Hello, everyone. Welcome back to another episode of Signal or Noise. This is episode 47. Charlie Bilello with you, and also, as always, Peter Mallouk. Peter, one topic for today. Everyone could probably guess what it's going to be. That would be the tariff tantrum going on in the markets. A long time ago, it was probably over a decade ago, we had the taper tantrum. That seems pretty mild by comparison, but we're getting a lot of questions, needless to say, about the tariffs, the markets, the economy. We're trying to answer as many of those questions here as we can. So let's dig in and start out with just a backdrop of why are these tariffs being put in place, whether you agree with them or disagree with them. This is kind of the backdrop causing the tariffs to be put in place, is this huge, enormous trade deficit that the U.S. is running with the rest of the world. And pretty much every major trading partner is showing a huge surplus versus the U.S., and U.S. has a deficit. If you go to China, Canada, Mexico, every single one, Peter. So we're looking at 1.33 trillion over the last year, which is a record high in terms of the deficit. And would you start out fundamentally from the standpoint of the tariffs? Do you think that there's a case to renegotiate some of these trade deals that have been clearly working against the U.S. to create these huge deficits?
Well, I mean, they've been working against the U.S., but on some level, there's a very good reason. So let's just start with the basics, because not everybody in our audience, understands this. I mean, tariff is just another word for a tax, and when a good comes into the United States can impose a tax on it. The definition of that is a tariff if it's being imported, and that gets passed on to the consumer. It's that simple. So it makes the good coming in from overseas cost more, which makes an American more likely to buy an American version that now will cost less, but wouldn't have without the tax. It also can then incentivize people to invest in the United States in building factories and creating products here, because they know that the lower cost of importing is now gone. Like Apple would know, hey, I can't import these parts from China at a lower cost, because after the tax is imposed, after the tariff is imposed, it's going to cost more. So I may as well make it here. And of course, when you do that, 100% of the time, it will cost the consumer more, right? The argument that someone in support of tariffs would make, well, is it'll cost the consumer more, but there will then be more jobs in the U.S. and many of those will be good jobs.
Right.
Now, so in reality, and I think let's just get all the politics out of this. When you combine politics and money, I mean, my God, you know what I mean? If we could just throw a sex scandal in this, that's the only way to make this, more crazy than it already is. But you combine politics and money, and you got two very hot button topics for people. So let's just roll with the facts. The reality is 85% of countries have favorable tariff system compared to the US. The US is not the only country on earth that imposes tariffs. So does the European Union. So does Canada. So does China. So does Mexico. And so do many, many other countries. And so other countries have tariffs on our goods going in. We have tariffs on goods coming in from other countries. But there is an imbalance in favor of other countries 85% of the time. So, okay, that's one fact. And you could argue, well, that's a fact that really supports having tariffs. Let's straighten this out. It should be more fair. If we are going to not tax goods coming in as much, that makes other countries' goods more competitive. Maybe we should negotiate so that other countries equalize that, so our goods can be sold overseas more favorably. Okay, great. Vote in that corner. The other thing is, and your chart shows, we've got this trade deficit. Well, that's not because tariffs aren't unfair. That's because America is the richest country on earth, and because we are not savers. Everyone spends everything that they have, and we spend like drunken sailors. And so we have a huge trade deficit, not really because the tariffs are unfair. That's not the reason. It's because we spend a ton. We just do. And so if the United States is running at a deficit, and we run at a deficit every single year, it's because we're spending more. And so we're not going to tariff our way out of that reality, right? If you want to fix the U.S. deficit, you've got to do a lot of other things.
So we're
Now,
financing this deficit through borrowing to spend money now as opposed to later, and that's pulling
yeah,
forward demand.
it's a train wreck. So your question, why tariffs?
Yeah.
There's been three reasons given to us. Like one, let's just toss out the window, which is the national security reason. I mean, I understand we're trying to expand the range of possibilities to possibly negotiate better deals, but I mean, no one's buying this one, right? We did learn in COVID that, hey, wait a second, if I can't get chips from Taiwan, that's going to be a big deal because I need them for cars and washers and dryers and also for weapons and to run the electrical grid and things like that. So, United States is already under Trump and Biden administrations, under both of those administrations, had made the decision bring the national security stuff back to the United States. I don't think anybody's arguing with that. Yeah, we'll pay a little bit more for those things because we need them to function in the event that there is a not just a war, but something like COVID, where we don't want to be dependent on the supply chain for things to come over. Toss it out the window. We don't need to have bananas and avocados and iPhone parts and so made in the United States for national security reasons. No one believes that. Let's set that one aside and get to the two big ones. So one is the Trump administration is really selling hard, really trying to sell hard the idea that, hey, we're just going to bring all these jobs back to the United States. Those T-shirts you're making in China, all that Lululemon and Nike stuff made overseas, we're going to keep these tariffs in place, and we're going to incentivize Lululemon and Nike and all these beauty care product company and all this stuff that they're going to create plants in the United States, and they're going to make this stuff here and sew it here and dye it here and deal with the waste here and distribute it here. That's what's really, really, really being sold, that this will create a lot of jobs. Now, let's just break this down. Would it create a lot of jobs? Of course it would, because we have a deficit. So there's more stuff being done overseas in this regard than here. And some of these things are highly skilled. That is absolutely true. A lot of it is not, right? So the idea that we're just going to blanket do this doesn't make any sense, because we don't want to make the Nike shoes here and the Lululemon tops here and so on. These are going to be very low paying jobs. And it's not good for the US consumer. It's not good for those companies. And I think that the administration understands this, which is why it's hard to believe that we're going to go all in, right, and really impose this for a very long period of time. And then the third reason is, hey, this doesn't seem very fair. You know, we other countries impose more tariffs than we impose on them. Let's straighten that out. I think that's what this is about. Like, look, that's not I do not happen to be in the majority right now, but I think that that's what this is about, and that they're going to let this go on for enough time for there to be some pain, and then you're going to start to see some negotiated settlements. So why tariffs? It depends on, are we going to believe exactly what's being said? Or are we making predictions about where this is probably going?
Right. So then the key question, if you think that we should increase the tariffs, I guess, well, how much? Right. And there's a lot of variability. This is just a chart of one of the, a number of the leading countries. Notably absent here are Canada and Mexico, which seem to have separate agreements, and we're not really sure how that's going to play out. But you can see here, there's one column saying what's the tariffs being charged to the U.S., and some might debate the calculations here. They're including currency manipulation and trade barriers in that number. And then on the right side is the reciprocal tariff in place that we're putting in place against that. And in many cases, we're doing, let's say, half of what we're saying they're doing to us. In other cases, we're matching it. If you look at the UK, 10%, they charge us. We're going to raise ours to 10%. And the minimum level that they're saying is going to be 10%. Now, Peter, there's a lot of numbers here. This is obviously a huge shift if this actually stays in place. But is it your belief that the proposed tariffs are for many of these countries are actually going to be put in place? Because I think the big surprise here was not only the magnitude, but that it was going to be kind of across the board without exceptions for goods that we don't currently have in the U.S. So we don't have the manufacturing ability, or if you take something like avocados, we don't have them right immediately available. If you tariff that type of good, it's just obviously going to increase the cost right away for the U.S. consumer, which is different than something with a national security risk or something where we can substitute it or make it here in the U.S.
I mean, just think about, like, just take your avocado example. So we know we import almost all of those, right? And so the idea of the tariff is you impose a tariff on that, and then people are more likely to buy from the avocado farmer in the US, but we don't have, the avocado farmers in the US to offset that, right? So automatically that tariff tax just gets passed on to the consumer, just like you said. Now let's think about the farmer. If you're a farmer, you've got a crop that's less profitable than avocado, but it would take a lot of money and time to shift your crop over to avocado. Are you going to do that today? are you going to spend the next whatever it is? I'm not a farmer, obviously, 6 months, 2 years, whatever it is, to get everything turned around? If you're Lululemon, are you going to go build a bunch of factories and invest in how to dispose of dye? And are you going to spend the 2 years and billions of dollars to do that? Of course you're not, because you think this might all get negotiated away in a couple of quarters. I mean, so for this to even shape reality at all, it has to go on for at least a year. You have to convince the people that are going to have to make these huge investments that this is going to be sustained. And I know that the administration is really trying to sell that. They've sold it enough that the markets are questioning, right? But it's still a big leap towards countries taking action. Now, you're right. The market's surprised at how broad and how deep. Basically, we're taxing islands that are uninhabited, taxing allies where there appears to be no issues, taxing countries where there's very little discrepancy. But I think the message was just that we're trying to make was kind of a shock and awe campaign. I mean, tariffs is as much of an economic war as you could have. This is an actual war. It's just you could have a military war, you could have a cyber war, you could have an economic war. These are the big ones, of course, social and getting all of that. But the big one is, after military, is economic, and that's what we're in now. And basically, we expected targeting, maybe not precision. Let's be frank. I don't think anyone was expecting precision. We were expecting this to be somewhat targeted, and it's just full on. We're taking the world all at the same time in a much bigger way than we thought.
Yeah, and the counter argument would be, well, they started the war, and now we're retaliating, we're making it fair, and in the end, it'll end up better for the U.S. You have to make a leap of faith to believe that. Yeah, there's a lot of assumptions and working parts, but going back to that national security argument, do you see any situation like you said we had been doing this already with in terms of semiconductors and steel? Do you think it makes some sense to carve those out and say, well, we don't want to be dependent on adversarial countries? We saw that during COVID. There's a shortage of many goods. And do you think that that does make sense in terms of finding those industries or goods where you're going to need during difficult times? And obviously, we definitely don't want a world war, but God forbid that were to happen, the U.S. wouldn't be in a good position today because it's lost its ability to manufacture many of these critical products.
Yeah, I mean, the United States basically, through globalization, started to, do whatever you could get done at a lower cost anywhere else. That's what was happening, which is great for the consumer, right? It gets you the lowest cost solution to the consumer. But what we realized during COVID is we became very dependent on the supply chain. A lot of things require a lot of parts, not just toys, but like all kinds of things, right? And if you're missing one key part, that thing won't function. And so if you need that to operate your country, it's best to bring it home and pay more. And we're already doing that independent of the tariffs. So I think this piece of it makes sense. It just didn't need, this piece of it makes sense, just not really part of the tariff war. It's really, regardless of tariffs, should be done in the United States.
Okay, so how about those jobs, Peter? What and this has been a big push, right, in terms of manufacturing jobs. There's no denying manufacturing jobs in the U.S. are much lower than 40 years ago. The debate is, do we want to try to bring those back? Is it possible to bring those back? Many have made the case these are higher paying jobs with better benefits, and a lot of those went overseas to China, and then more recently they're being shifted to Mexico, and then they'll just go wherever it's cheaper to produce. And the counter argument would be, well, we've replaced these with service jobs and we're in a better position to export those services to the world. And some people would say, well, yes, but those service jobs aren't as good as manufacturing jobs. It's very complicated, but no question, the manufacturing job in America was a big thing 40, 50 years ago. And today it's less important. The question is doing something like this, and it has to be sustained, right? As you said, will it actually bring these jobs back? And is that something as a country we want to pursue?
Well, I think part of the reason I think, we call it both sides, you can talk past each other, is oftentimes there's truth in both. And both arguments here are true. So like when you hear one group say, hey, like, look, if we just have these huge tariffs, we keep them in place forever, these companies will have to make all of these things in the United States, and it will bring more jobs to the United States, uh, and many of these are highly skilled jobs. And the other side says, hey, like, look, that's going to cost more for the end consumer. We should do this wherever it's the lowest cost, and a lot of these jobs are not highly skilled. Both of those are true. So this is why having tariffs be selective would be nice. It is true that some of the work that go overseas is not just because it's lower cost, but because it's highly skilled and lower cost. Why we get our chips from Taiwan and why Apple does certain things in China. Some of the things that we are getting overseas require very high technical skills. They would be good jobs in the United States. They require a very large capital investment. They'd be great jobs. That's true. But they're still doing them overseas because they want to deliver the end product to the US consumer at a lower, more competitive cost. It's also true that the majority of what is overseas are actually low paying jobs that in a world where unemployment is in the lowest decile it's been in US history, we're not going to find people to take those jobs, right? So, okay, great. Nike brings the shoe factory back to the United States. Give me a break. There's not going to be a line for that. There's a lot of other jobs open today that would pay more than that job, right? So both are true. There are a lot of jobs that they're overseas for good reason. We don't have enough people in America to take those jobs. Unemployment is too low. It's not we have 10, it's not '09 where we have 9% unemployment. And yeah, a bunch of people might take these low paying jobs. We don't have that today. It's also true that some of these are highly skilled. And so I think this is part of why people don't hear each other when they debate a topic like this.
So the jobs we want are the higher skilled, higher paying jobs where someone would leave that lower paying job for that job,
That's
essentially.
true, and that's also you can even debate that, right? So on the one hand, it is true that some of those are highly skilled jobs that would be good paying. We bring those back to the US, it will cost the consumer more, right? So now here though is a very legitimate debate. Like, hey,
Mm.
who cares? It's going to cost the consumer more. It'll be good for America because that's a high paying job that could be fantastic for that family and so on. To me, it's the Walmart debate. Walmart comes to a city, and what happened when Walmart first came to a city? There were a lot of businesses that had they had small shops, and those small shops got destroyed. I owned a music store in college, and Best Buy would come, and your music store would get destroyed, right? So Walmart comes to town, and 100 businesses close. And in a strong economy, those people go do other good paying jobs, right? In a weak economy, it's very, very negative. But what happens for the whole city? The whole city, that small town where maybe the working wage is low, they all get the equivalent of a tax break because every single thing they're buying now costs less when they go to Walmart. I'm not arguing the good or bad of it. That's basically how this works when you talk about the tariff thing. We can go to every town in the United States and say, no more Walmarts, no more Costco. All this stuff has to be gone, right? And you would have more jobs. You would have more mom and pop businesses, and everything would cost more for the end consumer. And so you can see the debate here, and you can see how it gets very personal very fast.
It would have to be a huge transformation, right, for the US economy to go back
Have to
to
change
that.
everything. This would take years, and have a severe recession in the middle of it if we wanted to get to that point. But just to get back to the beginning of this topic, it's not good for the United States to bring back every job. Okay, I don't see how a reasonable person can say this because we don't have people to take them, right? We don't have people that want most of these jobs. Some of them are specialized and complex and well paying, but a lot of them are not.
Yeah, it's a tough one, right? Because most of the countries around the world, most of our trading partners, they have an absolute advantage, and the standard of living is much lower, and the wage is going to be a fraction of the U.S. So how do you normalize that? I mean, the tariffs have to be so onerous, right, to equal that playing field.
And this is why, trade can be everybody can win in many scenarios. When you take that job that someone in the US doesn't want, let's just pick a job everyone agrees someone in the US doesn't want, and you take it to Vietnam, that can be one of the higher paying jobs in Vietnam, right? So their quality of
Yeah,
life goes up. The US consumer pays less, so their quality of life goes up because they have more disposable income. That's the idea of trade, right? That's the idea of having trade.
how would you respond to the people that are saying, well, big business for 40, 50 years has been in favor of this globalization move and it has hurt the average American, even though what they're paying at Walmart, as you said, might be lower? Well, it's hurting them because they have a lower paying job. That's been a big push. If you look at places like Detroit, they've made kind of that argument that it's helped the big corporations, helped their bottom line, no question, because they've exported this to other countries. Labor is cheaper, the bottom line goes up, right? They're just trying to maximize profit and they're not caring necessarily about the average American.
Well, that's 100% true. So I would agree with that comment. A corporation has only one fiduciary duty. That's their shareholder, and that means they want to create profits. To create profits, you have to sell stuff where the cost of making it costs less than what you're selling it for, persistently. So the corporation's going to say, okay, if I want to make a car and I want to sell it competitively, and this car has 300 parts, where can I get all this stuff put together at the lowest cost? The same product at the lowest cost. So by definition, you're going to go to markets where you can get certain parts done for less. And if the entire car was made in the US and everything was made in the US decades ago, right? Of course, that's at the expense of US jobs. So yes, the corporation only cares about profits. That publicly traded company is only going to care about profits. And the second part is true also. The consumers buying cars universally benefit because it costs less than if it was all assembled in one country, whether it's Germany or the United States or whatever. The same thing with an iPhone, the same thing with the Nike shoe, right? When you take part of the Nike shoe and you make it in China, it's going to cost less than if it's made here. And then the third part is also true, which is there is a group of people that were working on that in the United States that are no longer going to be working on that. And there's three outcomes. One is they have no job. This is a recession, depression, there's no job. The second is they have to move to a lower paying job. And the third is they move to a service job or another job where they actually make the same or more. Now, what has actually happened is the overwhelming majority are not out of work because we have close to full employment, right? We have plenty of opportunity. We do know that the majority of people have been able to move to the same or higher paying job. That's just a fact. But there are segments where that is not the case. And it usually couples a skill set with a geography that doesn't provide the other opportunity. This is, and you could see this in the original election with it was Trump versus Hillary Clinton, right? Where Trump won those Rust Belt states, where you saw this exact scenario unfold, where there was a group of people that were truly disenfranchised, not heard. Many of their jobs went overseas or not tech jobs in their backyard. And that was how that election swung. So the thing is, all three things you said are true. It's just varying degrees with all of them. It's not an either or.
It's an interesting hypothetical. If there was such a thing as you made the product in America and you made it overseas, and the American product cost 10% more, you had two separate choices, but then you're supporting. Would people actually pay more? Probably not at the end of the day, right? Like, but would you pay more for that iPhone that's made in the US? Like, personally, I would, for ethical reasons, knowing the conditions in China, but I'm not sure the market that's how it would play out. It probably wouldn't.
Yeah, I don't know there's an appreciation for just what this would do to cost of living in the United States for everything, from walking through a grocery store to everything that we wear. I don't, everything, all the technology we use. I don't think there's an appreciation for the instant price hike of everything for a long time if this were actually going to go into effect.
Okay, so let's go to the negotiating tactic. This question seems obvious, but is this just simply a negotiating tactic, and everything that we showed before is likely to be revised? Is
Well,
that
it's fascinating.
yes?
I just read an article of The Economist and reading the New York Times, Wall Street Journal. I mean, people are writing as if this is the new reality. I I I don't understand. I mean, I think this is a negotiating tactic. I think that I would hope that there is enough knowledge throughout the administration that having permanent tariffs and 100% of the time for forever and bringing everything back to the United States. I don't. I mean, I just don't think that that's really the end game here. I mean, that you have to take that position, I guess, if you want to negotiate. And look, in negotiating classes, they teach you that the hardest person to negotiate with is somebody that's appears to be irrational. And I've just seen this, in my career, especially through the law practice where I watch negotiations. The hardest person to negotiate with is someone you don't know what the heck they're going to do and when they're going to do it or why they're going to do it or how they're going to react. And so part of that could just be a tactic. And the other is to really expand the range of options. You are, you're negotiating. Oh, will the tariff be 3% or 5%? And instead now it's 35%. It's going to be forever. Wow, the range of options has really expanded. The person on the other side coming to the table, what they might consider a victory may have shifted quite a bit. And so I think this is a negotiating tactic. I think that it only work as a negotiating tactic if it goes on for a little bit of a period of time. But I do think what we're ultimately going to see is we're going to see the first agreement with some country somewhere, sometime in the next few months, maybe even within days or weeks.
Yeah, I was gonna say probably this weekend
Yeah,
if
but
we
if
get
that
some.
happens, I think then there would be a lot of credibility lost with all the other countries. So I'm not sure how fast he's going to move, but it could be that quickly. And then we're going to find out, okay, this was just, the most significant economic bluff in the history of the world. And we'll get settlements with a bunch of countries. But you know what? Nobody knows. The market
Mhm.
does not believe today, as we speak, it's moving quickly, that this is permanent. If it thought it was permanent, it would be down 30, 40%, maybe more.
Yeah. Well,
So, but what
nothing's
it does
permanent.
believe, I think what the market does believe is by the time this gets resolved, there could be permanent damage. So I think that's where we are here, but it's very early.
Yeah, the longer it goes on, the more uncertainty, the more problems
Right.
this keeping this type of stance could cause. But I guess the surprising thing, because we saw a month ago with Canada and Mexico and Colombia, the tariffs are on, then we're off immediately,
Right.
right? So the threat worked almost immediately. Here, it hasn't even been enacted yet. I think they're going to start this weekend, but the assumption is that this is going to be longer lasting. But I would just say, in general, the permanence of this, there is no permanence. If this ends up being really bad in the next year or two, you're going to see massive losses in terms of the midterm elections. And then 4 years from now, there'll be a new president and they'll reverse this. So there is the idea that this is going to be the case for 30 years, 40 years, which is what corporations really trade on as their long term earnings expectations. That, in any sense of the word, if this ends up being bad, I don't see how that's possible.
Well, yeah, I wouldn't say, yeah, permanent's not a good word. Like, to
Yeah.
me, like, this is like, with COVID, we didn't know, could we come back outside? 9/11. Oh my God, is there going to be another terrorist event? 08, 09, when's the next domino going to drop? I don't understand how all this works together. This is different. We know why there's a traffic jam. We put a roadblock in the road, right? So we can pull the roadblock away. The issue is going to be, does he do it so long from now that we already have gone into a recession, right? That's
Mm.
the So not permanent, but have a short-term real damage caused by this going on too long. So to me, I don't believe, we're all in. We're looking at your question here. What are the possible outcomes? Well, the worst case scenario is this is really happening, right? That we really have a tariff war. These tariffs are really going to stay in place. We're really going to restructure the way the whole world works. Everyone's going to make everything they need in their backyard. And I understand a lot of people believe that's what the path is, and that would be good for America. It would not be good for America if every single thing came back here and stayed here.
If you had to put a
Yeah,
probability on that, Peter, I know it's
yeah. So
a hard
I'll
thing to
put
do. Would you say less than 25% chance of that
Well, I'd
worst
say
case?
less than 10% because
Less
it's
than,
so
okay.
it's so preposterous, But I mean, like, look, many people believe that's what's happening here. If I put it at less than 10%, it would be devastating for the economy. The market would take a big hit. We'd have at minimum a severe recession. Okay, now
Okay.
the best case scenario is this is all just a negotiating thing. He sold it really well. A lot of people believed it, and he reaches quick settlements with the big players, and that the settlements put the U.S. in a better place. That other countries have to remove some of their tariffs, so our companies can sell more to their countries, which would be amazing for the American worker because we would be selling more of our stuff overseas. Those companies would need to hire more people at what
Mm.
they're already good at, right? And so now we've got these more jobs and we still have the low cost of goods that are coming in from other countries, and we're able to have more fairness. We have at 85% of the countries, the deals are not fair or not equal, let's call them. And we can get closer to equalization, and we might even get other concessions around other things that might be on the administration's agenda
Right. So you don't
around.
hear a lot of you hear a lot about the back and forth, the worst case scenario, but the best case in that we remove ours, they remove theirs, and it's just better for everyone. That's a
Yeah.
possibility as well. Would you
Well,
put
for
that
yeah, I
at
mean,
equal to the worst case scenario in terms of probability?
I'm optimistic here. I put this at like 35, 40%. I mean, very high that we're going to wind up with literally every single country a better arrangement where we go, okay, look, we'll remove the added tariffs we did, but these tariffs you've had historically that are
Mm.
disproportionate on our companies, you'll remove them. That'll be great for the American worker. It'll be
Yeah.
more fair. We might even get other concessions that the government cares, that the administration cares about. I think this is very likely. And then the mostly bad scenario is that they're shooting for the best case scenario, but that they take too long and that it creates disinvestment and enough uncertainty that it starts to drive unemployment, starts to drive less purchasing, you have less corporate earnings, and we wind up with a mild to real recession. And I'd put that at, I put the worst case and mostly bad scenario. Let's do it this way, at less than half, and the a good to best scenario at much more than half.
Okay, so let's go to that recession question. This is the Atlanta Fed's latest estimate. It's been jumping around, but negative 2.8%. And really, all of that's from the data on trade that we got showing a lot of companies are pulling forward their purchases. So we're going to see net exports go way down during the first quarter. That's the assumption, at least as of now. That's going to cause negative growth in the first quarter. Now, what will happen in the second and third? Will we see it move in the opposite direction? Who knows? But you have big banks, of course, JP Morgan, many other coming out now, upping their recession probabilities to 60% or more. Um, I guess the worst case scenario, of course, this obviously a recession would result, but is that your base case expectation, even for the mostly bad scenario, that we could have a technical recession this year if this plays out without any changes?
That's right. I think the mostly bad scenario comes with a technical mild recession without very high unemployment, just a slowing of the economy. But like, look, there's been a recession predicted so many times in the last 5 years. It's almost comical. And so the odds of a recession were pretty low coming into this year. Of course, they're higher when you're in the middle of an economic war. You don't really know how long it's going to take to resolve. But it's hard to get away from the fundamentals that unemployment is incredibly low, that the Federal Reserve has rates high enough that there's plenty of room, plenty of dry powder for them to lower rates, lower rates, lower rates, which we know has gotten us out of the last few recessions. That if you're going to have an economic war, I'm not a fan of having one like ever, but if you're going to have one, this is the time to have it when you've got an extremely strong economy. You've got interest rates with room to move lower. You've got very low unemployment, middle of the AI revolution that's hard to ignore. I mean, there's a lot of room here to work with. This is very, very different than COVID, 08, 09, 9/11, all these other uh, market events that led to recessions.
Okay, let's end with the markets and the reaction here. End of the first quarter, Peter, we saw the biggest divergence between U.S. and international stocks that we've seen in over 20 years. You had international stocks up 6%, U.S. stocks down 4%. We know for over a decade it's been going in the opposite direction. And we finally saw this enormous reversal. You had European equities up over 10%, and bonds doing their job during this risk off period, actually up a few percent as yields have fallen this morning. We saw the 10-year actually cross below 4% for the first time in a while. Now, fast forward to data through yesterday, things have gotten worse. International stocks still outperforming, but they were starting to take a hit as well. US stock market declines deepened here. And the really big, interesting thing, Peter, is that the Magnificent Seven has finally reversed some of that outperformance that we've seen over the past few years, with all of the names in the Magnificent Seven underperforming the S&P 500 this year. And if you look at the equal weight, way underperforming that. You got Meta down 9% and Tesla at the bottom of the list down 34%. So interesting to see that within this correction in the market, it's it's hitting the names that have done the best, the highest valuations, and the worst. And I don't know that that has to do with tariffs or anything else. It's just a classic kind of risk off move where investors are rotating into defensive areas. You look at consumer staples and utilities and healthcare; they're actually still up on the year.
Yeah, I think it had nothing to do with tariffs. To your point, like if you look before the tariff announcements, international stocks have been doing better than the U.S. Value had been doing better than growth. So we saw that rotation begin. Now it's begun before and not stuck for the year, but it began and it had some real legs. But if you looked at the S&P 500 last year, it was up over 25%, did amazing, crushed international stocks. But if you
Yeah,
take out the Magnificent Seven, it didn't really do that much better than international. The story was really the Magnificent Seven. We say, oh, large US did better than small, it did better than international emerging markets. It's really the Magnificent Seven doing it all. Well, this year, If you take out the Magnificent Seven from the S&P 500, the S&P 493 was positive year to date coming into the tariffs. Really, we had
Mhm.
only one bear market happening across the world that was major, and it was the Magnificent Seven. Just the market thought, hey, these are overbought, these are growth stocks, let's take a breather. And that was before the tariffs. Now, with the tariffs, we're seeing weakening across the globe because, of course, this becomes negative for every country to varying degrees. And this is just a separate story inside what's become an all consuming tariff story today.
Right. So here we are, worst start to a year we've seen since 2020, down 8% for the S&P. But as you can see here, it's not preordained what's going to happen. Half of the time, the market actually ends the year positive. You have these huge rallies. Other times, you see further declines. But I think the point here, Peter, as we saw in 2020, don't assume what has happened so far this year is going to continue. It could, but it's not necessarily the case. And especially given the uncertainty that we talked about, anything in the positive direction that now comes out, well, that investors aren't really expecting today. So the S&P, I've been updating this table very quickly the last few days because every half hour it seems the decline seems to deepen, but it's a 15% pullback now. We tend to see that almost every other year on average. We saw in back in 2018 an even bigger decline. It's hard to imagine that on the same reason, tariffs and trade wars. And so the question would be, could this be another bear market? And the answer should be, of course it could be. But longer term, if you're a longer term investor, you should be looking at this spike in volatility as an opportunity, because when we see the VIX spike to these kinds of levels historically, what do we see following that? We tend to see better than average future returns. So we had the VIX this morning above 40, very rare that it gets in that type of scenario, and you tend to see better returns. And I'm showing you here, what if we have an absolute collapse today or next week? Well, these are the returns, Peter, following the worst weekly closes for the VIX historically. You can see a lot of green in that, and people should be looking not at the 1 year returns, which are all positive, but really the 5 year returns where the S&P 500 doubled in all of these cases.
Yeah, I mean, this is for those only listening. I mean, the 1, 2, 3, 4, 5 year in every single time in all of history where the VIX has behaved this way is positive. I mean, it's just an incredible, incredible chart.
And these were the absolute worst moments, even in today, March 2020 and October, November 2008, March 2009, right? These were absolute crises where the fears were even worse and the uncertainty was even worse today. And the market found a way to go higher. And I'll just end with sentiment here, Peter, because last year, mostly we were talking about the opposite of this, where people were exceedingly bullish and the market was hitting all time highs pretty much every week. Well, now we have the highest bearish sentiment that we've seen since March 2009 in this individual investor poll. It's actually only been higher two times. That was in March 2009 in the week during the low, and October 1990. Some of the listeners might remember that was a bear market and recession. That was also at the week of a low. So no predictions here, but much better to be investing in a period where other investors are bearish and there's a lot of fear in the market than the opposite. So this is, we talk about signal or noise, is a much better signal when you see this type of fear going on in the market. And we'll end here with a chart showing you what happens typically during drawdowns. And this is an important point because people think that drawdown is only going to weaken. But Peter, historically, what has happened during this type of 15% drawdown?
We know that the 1, 3, 5, 10, 20 year, all above expectations, all above historical norms, double digits across the board, triple digits over the long run. Drawdowns are a disciplined investor's best friend. This is why you get paid more to own stocks than bonds. Stick with it. And if the opportunities get more significant, maybe lean into it.
Well said. All right. Thanks everyone for joining us on this special Signal or Noise Tariff edition. If you're watching this on YouTube, hit that subscribe button for more content just like it. And we'll see you next time on Signal or Noise.